Good Thursday afternoon to you. Welcome to the Jon Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you, and absolute pleasure to be with my co-host. Around the horn we shall go. Dwight Millard, Highlands Mortgage. How are you, my friend?
I'm doing good, John. How are you?
Very good, very good. Corey Edge Realty, Big C. I like it. You're wearing one of my sweatshirts. I like that one.
Well,
Yeah, that's
when we first started this, I said, "Do I have to comb my hair and get dressed up every day?" And you said, "I wear hoodies, so I am combing my hair, but I am wearing a hoodie."
good. Well, glad to hear that. Absolutely. Wear whatever you want. Let them see
No,
us. Let them see us at our
don't,
finest.
Yeah, be careful
don't
there,
tempt me.
John.
And speaking of seeing, I want to bring on our marketing director, Bailey Sanchez. Bailey, just real quickly, I want you to come on and give everybody a brief overview one more time about speaking about how they can see us. Beautiful. Bailey, while I have you on, guys, I want to share this with you because Bailey knows the facts better than I do. So, each and every Monday, I have my brother, Dr. Dennis Sanchez, the AI doctor, on. We've been doing, these AI segments on Mondays. And we wanted to contribute to helping people that are feeling so scared of AI and so much so on and so forth as far as losing their job or, what is this crazy thing called AI? So Dennis has put together a course, and we offered it out to our listeners on Monday. And Bailey, the response was overwhelming. The people that want to learn, it's a video. You described the video series. It's pretty amazing. Yeah. Beautiful. Yeah. Excellent. Yeah. Yeah, guys, the response was incredible. I was so pleased that so many people have an appetite to learn it. Corey, I would say, are you still less tech savvy than Dwight and I? It's always been the way over. But where are you now? I'm just curious.
Well, those are fighting words, John. I mean,
Talk to the guy that doesn't have a website. I mean,
well, that has nothing to do with technology. I mean,
let's kid you.
that's just being a hermit. I mean, there's nothing wrong with that. But I mean, I'm sure ChatGPT has changed. The last time I did, you still had to go to the thing and get the account. Like when you guys talk about uploading pictures and all this other stuff, I haven't gotten that far yet.
I was just curious. How, because I know when we have Aaron on, we talk to him about how he uses technology in the world of real estate and things, and we always joke about you. So I thought I'd give you a chance to defend yourself.
And listen, I'm always way behind the times, but I see other people in my industry using it because when we do a listing, obviously at the bottom you got the little paragraph blurb,
right?
And you got to come up with it, and it looks fake to me. You can tell, like, beautiful Reno, Nevada, in the foothills of the Sierra. Like, come on. I mean, these people aren't even taking the time. Like Dwight always brags about, he still does his sheets by hand. Like, there's something to doing it and understanding it. And I don't know if you saw that case recently that was here in Reno, when it was a big case, but these attorneys filed their whole brief written by ChatGPT, and all the cases were bunk. I mean, it was a huge. So it's just like the internet, right? Like of course, it's going to change things, but some of it right now just feels.
You got to be careful. Yeah.
Well, yeah, and you want to use your brain, right? Like, I mean,
you do. That's right.
We're going backwards a little bit every time, I think.
Well, John, we were talking about it today. You can take your resume. I mean, these kids getting out of college, you can put it in Chat GPT, have it go through it, put in there what you are looking for, and it'll redo your.
Yes,
it makes you look like it makes you look like you were a senator or something, so they're gonna call you and you're gonna walk in and go, wait, that's not.
No, I didn't get an MBA from Harvard. No, what are you talking about? Yeah. But that AI on the backside, Dwight, is also the one that is screening those resumes.
Yes.
Going,
true.
Not good.
True.
Not
no,
good.
You're right.
I've seen this one before.
Yeah.
So
To
Corey's point, there's a fine line there. But
I have a friend he's in HR, and that's what they use. And he's like, there's little hidden words and hidden things that even if you write it out and it's perfect, that doesn't pick up on, I don't know, all the technology, but the computer won't pick up on what you're saying, but the ChatGPT one will pick up on, it knows what to write.
Yep.
But he goes, these people come in, they're not even qualified. I mean, they have no idea what their resume says. They have no.
Imagine that, Bailey.
Yes.
And valid facts, right? You don't want to lie on a resume. Not a good start to your career. Perfect. All right, Bailey. Well, thank you so much for bringing everybody up to date on that. All right, let me tell you about bringing you up to date, what we got lined up for you this afternoon. So one of my favorite shows we get to do each and every month, thanks to Corey and Dwight, we get to review our local real estate data. This, of course, will be August data. So we're going to go through your median price, our inventory level, how long it's taken to sell a home, all of the important facts that should help you make your decision whether to buy, sell, or so on and so forth. So we're going to go through that first, but then we're going to get into, since obviously the three of us were not together yesterday, we're going to go through yesterday's Fed interest rate decision. And folks, here's something that, kudos to Dwight. He warned us that this could happen. And that is, we got a 0.25% interest rate cut yesterday. And Dwight, what has happened with the 30-year mortgage rates in the last 48 hours?
Yeah, it's just straight up,
almost
right?
a
Just
quarter percent.
and John, how do you explain that to somebody?
Yeah.
That's the challenge. I mean, you've lost what, 25 basis points, if not more, just in the rate. This isn't. Yeah. So I mean, the reverse effect, right? I mean, everybody thought, and there's a lot of people, John, that waited to lock their loan. Till that, and he was somewhat friendly, I thought, about encouraging maybe some more, or at least another cut this year.
Right.
Boy, I don't know why the traders didn't like it. They don't like something.
Yeah, well, I got some reasons for you that we'll share when we get to that. But yeah, I want to squeeze that in because that's obviously very, very important. Like you said, people are going, well, wait a minute. Now, again, we don't blame us. We've been warning you that this could happen or this could have happened.
Let me give you a real live one. I locked a loan last week, and I brought up the rate. It's 1.25 worse in cost than when I locked it.
Amazing.
And he thought he was going to get better rate. Yeah. And I said, no, what you have would cost you 1.25 today had I not locked it.
Wow. There you go. The importance.
And I didn't, I had to do it because of the timing of getting it closed. So it wasn't, but yeah, he was hoping to just be able to renegotiate for a lower rate. That ain't going to happen.
Yeah, exactly. Crazy times we find ourselves in, no doubt about it. No doubt. So we have a lot of great things to talk to you about. Let's get down to today's stock market activity. Again, the day after the Fed interest rate cut, what did we see? Pretty good gains across the board. 124-point gain on the Dow, about 0.27%. NASDAQ rose 209, 0.94%. S&P gaining 32 points, 0.48%. And again, record-setting day for the three major averages. The Russell 2000 was also a very, very strong performer. It is now on a year-to-date basis up 10.7%, quickly catching on. Why? As we said on the show yesterday, the small caps, those are your young companies, the growing. They need to borrow a lot of money, get a lot of capital flowing. They go out, they borrow. Obviously, a lower interest rate environment is very favorable to them, sometimes even more so than the big blue chips. So therefore, please take a look at your allocation in your portfolio and make sure you've got some allocation based upon your risk and your goals into the small cap area, because this should be an area that continues to roll very nicely as we get into this hopefully declining interest rate environment. So 2.5% gain, by the way, was the move on the upside of the Russell 2000. Again, the other three, NASDAQ up 0.94. So you see that dramatic overperformance of the Russell, 2.5% versus 0.94. Now, speaking of rates, where do we sit right now? Because this is the big question. One of the big takeaways yesterday is, I think everybody's takeaway, right, Dwight and Corey? I'm sure you guys agree. Everyone's takeaway was we got more rate cuts coming. Obviously, the size we don't know, but the frequency, the street at this point is still saying, as we said a couple of days ago, October and December. Right now, I want to bring you up to date on the probability. According to the CME FedWatch tool, probability of a 0.25% cut at October is 91.9%. 91.9%. Just a couple of days ago. Matter of fact, right before yesterday's meeting, the probability was only 78.2%. Another 0.25% cut in December. Probability today, 82.3%. Right before the meeting yesterday, 72.8%. So guys, those are pretty good, solid probability numbers, which again are usually fairly accurate. So Dwight, you like seeing that, or maybe you don't?
I don't like seeing it. I don't know what I like seeing anymore, right? A big headlight coming at me. But John, I mean, on Tuesday we were 6.13.
Yeah. And
today we're 6.37.
That's right. Up 15 basis points today. Just
today. I mean, and you know what the headlines are? Deja vu, September of 24.
Didn't see that.
But yeah, because remember there was a probability. Remember they did the half point, then they did the other quarter.
Yes.
Pretty soon after that. So
yeah,
I don't know if they're buying this.
Imagine what would happen if we would have got the quarter or the 0.5% cut that some wanted.
Well, we'd have been back to 8 again.
Yeah, exactly.
I'm going to be selling suits.
Right.
So this is crazy.
I told you always have a job with Sanchez.
I appreciate that. I'm going to be the last Mohican.
That's
standing,
right. That's right.
We're going to stay here.
All
Yeah,
right, we
it's
come back.
John. It's hard to believe.
Yeah, it is. It really is. Well, we'll explain that when we come back, why these mortgage rates rose again when the Fed gave us a cut. And then I wanted to just quickly, the big story of the day was Nvidia and Intel. I want to tell you what's going on there. Let us turn it over to Kristen Snow, the wonderful Kristen Snow, in the Right Now Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Corey Edge of Edge Realty, Dwight Millard of Highlands Mortgage. Once again, a 124 gain on the Dow, the NASDAQ up 209, the S&P gained 32. Let's hit the commodity side. Give up a little bit on oil today, 79-cent decline, finished at about 63.27 a barrel. Gold also pulled back today, $39.60 loss, 3,678.40, and up 3 basis points, Mr. Millard, 10-year Treasury at a yield close of 4.1%. Once again, as you said, 6.37% on the 30-year mortgage, up 15 basis points today. And that's on top of what was yesterday, 12 basis points, if I remember.
Yeah.
It shot up?
Yeah.
Okay. So we hit 0.27 or 27 basis points increase since the Fed interest rate decision yesterday.
Well, and John, remember with the governments, the FHA and VAs were well into below the 6. They were in the 5.9,
Yes.
5. Now that they're 6.05 and 6.07. So that not been a good couple days.
Right.
I mean, it just started right when he started talking.
Yeah.
You started to see it. I'm like, what in the world?
Yeah.
You know, so
let's answer the question. Why are we seeing these mortgage rates go up, Dwight? So essentially, if you're a bond trader and you just learned that the Fed just cut interest rates 0.25%, you're going to go, okay. Now, again, what people obviously need to remember, and this is probably the most important thing that the three of us have discussed, the market, whether it's the stock market or the bond market, is a forward-looking indicator. It is pricing out 6 to 9 months what it thinks the market is going to do, or better yet, what it thinks interest rates are going to do. So the reason we have seen the rates come down prior to the Fed meeting is, again, it was already priced in. Now the market's going, well, let's see if the economy is going to improve. Right? We've got an interest rate cut cycle that we're just beginning. We've got an AI-driven economy. We've got all these, quote, positives, right? They line them up. They're going, why in the world do we want to own a bond, right? So let's sell our bonds, folks. And what does that do? Of course, drives those yields up. It really is that simple, from a fundamental standpoint. You agree, Dwight?
I do, and I think it's not to bring back bad memories, but this cut last year, just looking at this chart, we were hovering around 3.6, 3.7, and it started going up, and it didn't stop till it almost hit 5.
Yeah, the 10-year.
4.8, 4.9, the 10-year.
Yeah.
Yeah, so not saying it's going to do that again, but
that's the risk.
It's certainly the pattern.
Right. And that's to your point, Dwight, how do you tell somebody? And that's the hard part, and again, my hat's off to you and other mortgage professionals, and even, folks like Corey on the sales side of things, is the average person just does not know that, right? You read the headlines and it goes, Fed cut 0.25%, mortgage is going to go down 0.25%. And, they don't listen, we need a few million listeners to this show to get our message out, because we have emphasized this for weeks and weeks leading up to this Fed meeting, that this was a good probability that it was going to happen. And indeed it has. And I love the point that Corey just made. This may be the beginning of a increasing cycle, right, Dwight? I mean,
yeah.
We've done it before because
Yeah.
once again, people start looking, you have record setting days over and over again in the equity markets, and people go, why in the hell do I want to sit in a bond, yielding 4% for 10 years when, I can find the best, or, a hot AI stock that, may do that in half a day or an hour or something. I mean, that's the logic that's out there.
Well, and Johnny, you're talking about, again, the investment community. You got countries dropping bonds now, dumping bonds.
That's
so,
right.
I mean,
That's right, Dwight.
It's just a struggle out there to attract on the mortgage-backed security. And again, John, I guess if I'm sitting there and I want a little bit of maybe growth but safety, I'm not sure I'm going to go to the mortgage-backed security market versus the Treasury.
Sure.
I mean, there's your two sandboxes, right?
Sure.
So if you're gonna look at the bonds, you might go short-term over here. There's a lot to it, but like you said, what I thought, and I was telling people, is I wonder if they already priced in the probability of subsequent decreases. I mean, we dropped so fast. Yeah. So all of a sudden it's like, okay, well, that was kind of wow. There was no wow moment to that. So, okay, let's settle back in and, hey, let's get rid of these things and go right back into
that's it. That's exactly
Nvidia or whatever you're going to buy, right?
Yeah. Well, you got to remember, we talk about bonds in the relation to the mortgage side of things, right? But let's remember, why do you buy bonds, right? Why do we as brokers, why do we put bonds or bond related type of products in a client's portfolio? It's to hedge them against stock market declines, right? Historically, of course, when I was young in this business, it was really simple. Stock market got lousy, you move your clients into bonds, vice versa, and you would implement international allocations. Now we're one big happy world, right? So now we can't do that on the equity market side. If things start getting lousy, we can't go international because they're going to most likely get hit just like the US market is, or vice versa. But now, of course, as we saw happen after the financial crisis, we can see it where bonds go down, stock market domestically goes down, stock market internationally goes down. So where do I hide? You got cash, right? That's the only place that you quasi have a guarantee that you're not going to lose any money. So bonds, remember, folks, from an investment standpoint, you buy a bond, you're lending money. Let's just say it's a government bond. You're lending the money to the government, let's say for 10 years. You don't have to hold it that long, but let's say it's a 10-year government treasury. It's like, okay, once again, our yield today, 4.1%. So that means the government's going to pay you 4.1% every year for the next 10 years. At the end of 10 years, get your you get back $1,000. You may have paid a little bit more than 1,000 or a little bit less, but you're essentially going to get back $1,000, and you've made 4.1%. But again, when the stock market starts taking off, people go, well, wait a minute here. I've got inflation, close to 3%. So if I'm making 4.1, great. I'm only making, 110 basis points on my money. Is it really worth it? Right. And the answer is, well, geez, I hear about all these AI stocks and I hear all these companies doing great and on and on. So I'm not going to do it. So they lower that allocation. The only ones, to your point, Corey, I think you said about the institution, or Dwight, you said it on the institutions, they can't do that, right? They have mandates, right? An institution, a pension plan, sovereign wealth fund, that type of thing. They have to keep a certain percentage at all times in stocks, in bonds, in alternatives, and so on and so forth. So no matter what they think they want to do, they can't. That is their rule. That's their investment policy statement. If you're a 60-40 shop, you got to stay 64 or 60% equities, 40% bonds, no matter what goes on. And that's where one of the challenges. But everybody else, bonds are a trading vehicle, and you get something like a market moving thing like the Fed interest rate decision yesterday, and the traders go, you know what? For all those reasons I mentioned, I don't want to be in bonds. They sell them. They start driving yields up. It's a tough one.
And you take the administration right now, when they start talking about their successes, the investments, and this, it just is counterproductive to the bond market.
It is. That's a good word, counterproductive. Last thing, guys, I want to squeeze in real quick. Very interesting. Again, as many of you are well aware, it's been maybe a month or so. I don't remember the exact time period. The U.S. government took a stake in Intel. We all know that Intel, of course, was struggling for many, many years. Through the CHIPS Act 2.0, the government, we don't know if it was a grant, a lend, whatever it is. But the bottom line, Trump administration came out about a month ago and said, hey, you know what? Those billions of dollars Intel that we, quote, lent, gave, whatever they want to call it, you owe us some ownership. So the U.S. government took ownership in Intel to the tune of 10%. They are the largest shareholder. They don't have voting rights like a common shareholder does, but the U.S. government owns 10% of Intel. That was about an $8.9 billion acquisition or lend, or again, however they did it behind the scenes. So let's just say the government owns 10%, worth roughly $9 billion. Well, we wake up today, literally it happened overnight, and Nvidia said, hey, guess what? We like that company also. We're going to put in $5 billion, or we're going to buy $5 billion of Intel stock because we're going to do a lot of things. We're going to take an equity stake. We're going to have a multi-year collaboration to co-develop some custom data centers with Intel, some PC products. I mean, all kinds of things. So kind of bizarre that a competitor is coming in and making a capital contribution via the equity market into their company, but they did it. So $5 billion, which is nothing again in Nvidia. They did that. Street loved it. Nvidia today shot up $5.95, 3.49% to 176.24. Intel, just a stud, 28.79% increase, up $7.17 to 32.07. So now you got the U.S. government and you have Nvidia as major shareholders of Intel. That was a big story of the day. Speaking of big stories, how about our local real estate data for the month of August? Corey and Dwight have all that information ready. We'll tackle that when we come back. But first, let's turn it over to Jack Saban. He's got news, traffic, and weather. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Corey Edgeved, related to Dwight Millard of Highlands Mortgage. Once again, we finished with a gain of 124 on the Dow, up 209 on the NASDAQ, and a 32-point increase on the S&P 500. Record-setting day for those major averages. But it's now time that we switch things over to the world of real estate. How's our local real estate market in Northern Nevada doing? Well, the boys have the data. So, guys, let's get started with this and really figure this out. So, Mr. Edge, going to start with you as always. Let's talk about our median sales price, $585,000. Bring us up to date on this one.
So not down 2.5% from July, down 4% year over year from August. Again, I kind of sound like a broken record. It's down, not a huge amount. This chart seems to be kind of up, down, up, down. I sent you guys both. I know the audience, well, I guess the audience could see it if I stuck it up there. But kind of the long-term chart, I don't think see any of that. But we're just kind of bouncing. It's not the worst thing in the world. We're kind of bouncing along the top, if you will. We keep hitting these ceilings, come down a little bit, try to hit it again. I am starting to see some of the seasonality slowdown start to kind of play in. So we got to remember this is August numbers. Now we're in September, you get October, November. It's not unusual to see these things, start their downward trend right now. So nothing alarming, but it is down.
Now, some of the data, Corey, that I was looking at outside the scope of this report, indicating that this is really the first meaningful year-over-year decline that we've seen in quite some time, with, again, this down 4.1% year-over-year. Do you agree with that?
It's the first time we've seen it in 3 or 4 years, for sure. Because remember, Dwight and I have been talking about it. The last few springs have been really hot, then it kind of cools off a little bit in the summertime. Then we didn't have a good spring this year.
Right.
Dwight and I were joking before we jumped on the air that this is August report, but a lot has happened just in the first 2 weeks of September, including what happened yesterday.
Right.
We'll see if these numbers hold true, but as we were talking about at the beginning of the show, if rates do start moving up significantly, then yeah, it could have a negative effect. We were hoping it was going to have a positive effect. It could be different depending on what the bond market does.
Right, exactly. Yeah, because it seems like it wasn't that long ago. I have to go back to the data, but we were around 616 or so median this few months back, right?
Yeah, I think, geez, we're topping out at 625. We hit that back in April, May. Again, we've hit the 625 mark at least 5 times in the last 2 years.
Okay.
And always kind of bounced right down.
Yeah, that's kind of been our resistance level. All right, very good. Okay, not good side there or good data there. Let's go on to the closed sales. 186 closed sales. Take it away.
So I know everybody can't see the full report. We'll get into all these, but there's what looks like maybe 8 categories here.
Yes.
They have little arrows that point up or down, depending on if it's up or down. It's the first time in a long time I've seen they're all red. Except for the one that you want red, which is month supply. That one's green.
No.
Every single arrow is pointing in the wrong direction. But closed sales.
Meaning month over month and year over year is what he's referring to.
Meaning month over month, year over year. Closed sales, 386, down 5.6% from July of 25, up 1.3% year over year. Could be seasonality, could be fewer houses on the market, which we'll get down to there. Could be buyers. There's still a feel in the market, and I still have the calls where if you have a listing, people come through and look at it, you call to get feedback, and they're looking at 5 other houses. They haven't made up their mind. They're going to take some time. When you're out with buyers, they now have time to say, no, I love the house, but I don't like the way the backyard is facing, so let's keep looking. Whereas before, it was like, hey, you take what's on the market and you buy it, otherwise you get nothing. There's still that out there where they have some choices.
John, when you get those really well qualified buyers that can buy 600,000-700,000, to Corey's point, they're going to take longer time because they feel like they're in the driver's seat. I'll go look at as many.
That's what I was going to ask. That's what I was going to ask both of you. What are you hearing from your clients? Do they feel, meaning on the buy side, do they feel a little bit more? I'll use the term arrogant, a little more cocky, a little more confident now versus say a year ago, Corey and Dwight?
I would say they don't feel, I don't know the arrogance right word, but they do feel like they have more options. So they're not stressed about timing.
Okay.
So now the interesting thing will be they've been in a downward, their rates have been going down. So now if they feel like, hey, I have more time, but the rates are going to start pressing their affordability, do they make a decision to jump on whatever happens to be there? Or do they say, forget it, I'll come back later?
Well, John, and add to that, if you go into like a subdivision or if you get a resale and they're willing to drop it 30, 40 grand right there, you're just going to keep go fishing. You're just going to, wait a minute. If so, that's not helping narrow it down either. That's just expanding a wider net out there.
Okay, good point. All right, so once again, our closed sales for August, 386, down 5.6% month over month, up 1.3% year over year. Median days to contract, 29, down 5% month over month, up 14%. There's your point, Corey, year over year. Take it away.
Yeah, so this is where you want the red arrow because it's down. So the median days to contract from the day we list it to the day it goes pending in MLS, it's counting those days. So on average, it's taking 29 days for a house to be listed to go into contract. You want that as a seller, you want that number going down. You want that house to sell faster than it would. So down 5% month over month, not the worst thing. That's the trajectory you want on the seller side. But up 14% year over year just kind of shows me, it tells me at least, things are kind of still stagnant a little bit.
Mm-hmm.
It's still 29 days, which seems like an eternity in this market. But it's still, I can remember, I didn't know anything about, well, I still don't know much about real estate, but when I was a kid, and I, I just remember my parents were selling their house. I mean, they were selling our house, I guess. And I just, for some reason, I always felt like, man, it takes a
60,
year to
90
sell a
days,
house. Yeah, I mean, it's a long, long process. So I think we've had a little bit of too good of times. Yeah,
Yeah,
spoiled.
no, yeah, that's a good point. I agree with you 100%. Remember those days too. All right, how much are you getting for the price that you're listing the house at? So our list price received, you're getting 98.5% of that, down 0.2% month over month, down 0.7% year over year. Not much action there, Corey.
Not much action, and you're going off small numbers, so you got a couple red arrows, not a big deal. Again, this number will always fluctuate between, call it 97 and 102.
Yep.
Because it doesn't count the price reductions of what we went through to get to that number. So.
Right, exactly. Dwight, take us away on the price per square foot. Medium sold price per square foot, $321, down 2.7% month over month, year over year, down just 0.3%. I was shocked on that one with inflation and so on, tariffs, etc. I thought that number would be much higher.
I did too, but that it just showing the stubbornness of, just trying to stay in that range right there, that 320, 325 range, which is, I agree with you. I thought that was going to be a higher number, make it even more less affordable. It's going to be a bigger number. But
right, exactly.
That's encouraging, I think.
Yeah, no doubt. Okay, Corey, let's go to this next one before we go to break. New listings. We had 441 new listings in the month of August, down 17.4% month over month, down 12.5% year over year. So that tells me a lot of people are going, I don't like this market. I'm not going to list right now.
Yes. And so as a seller, you want that number to go down. As a buyer, you want it to go up to have more options. This could also be, I mentioned it on Tuesday because I've done it with a couple clients recently. You get to this time of the year and you have those frank conversations, say, listen, at that price, we're not going to get it. Let's try in the spring because spring is the time. So it's not surprising to get fewer listings as we get later in the season, usually for holidays, but some people just bank on a hot spring market in 26 and they'll roll the dice.
Right. Good point.
Corey, is there a report that shows where people took it off the market?
Yes. Yeah.
Okay.
Yeah, and I can pull that, and that is the one we talked about a couple of weeks ago, that across the country, canceled listings are, I don't think it's an all-time high, but the trajectory was through the roof. People pulling their houses off the market or canceling their contracts.
I've heard the exact same thing on a nationwide basis. Yep. You got it. All right. When we come back, let's talk about how many homes are for sale out there, our active inventory, and then our month's supply of inventory with Corey and Dwight. Let's wrap it up with Kristen Snow right now. Traffic Center. Kristen, back to the Jon Sanchez Show on News Talk 780 KOH with Corey Edge of Edge Realty. Mr. Edge, your phone number, Saul.
673-6700.
Mr. Millard.
240-2022.
Beautiful. Thank you, boys. Do appreciate it. All right. Once again, we've been covering our market, real estate market data for Northern Nevada for the month of August. Once again, let's recap what we've covered so far and get down to our final two categories. Our median sales price, now $585,000, down 2.4% month over month. Closing sales down 5.6% month over month. That's 386. Median days to contract, 29, down 5% month over month. List price received, 98.5%, lower by 0.2% month over month. Our median sold price per square foot, $321, down 2.7% month over month. And now, Mr. Edge, as you said, 441 listings, down 17.4% month over month, year over year, down 12.5%. Again, people are just sitting on the sidelines, as you were saying before we went to break, correct?
Yeah, sitting on the sidelines. It could be seasonality, it could be different things, but not unusual for that number to start heading down.
Perfect. And I want to remind everybody, now that we are, again, broadcasting simultaneously onto YouTube, those of you that want to see this report, again, pick up our YouTube video, The Jon Sanchez Show, and you can see all of the data that we're talking about here. All right, guys, our last two reports. Corey, active inventories, 1,199 units, down 4.9% month over month, and up 13.2% year over year. So that 13.2%, I need increase year over year. I need an explanation on that one.
That's just more inventory than we had last year. I mean, that's what has stabilized pricing, maybe brought it down a little bit. That's what's giving the buyers all the feel good about being able to look around and not be so stretched. We've been slowly getting increases in inventory, pretty much every month this year. The reason I think it's down month over month is because we didn't have the new listings this past month to add into it.
Right.
But if you remember, I mean, 1,200 houses as active inventory is it's not a huge number, but for what we've done the last couple of years, it's a pretty sizable number. And we'll get down to the next segment, but it equates to 3 months supply, that's the first time we've crossed 3 months supply in a while. So it's interesting.
Well, let's wrap it up with that with 90 seconds remaining. 3.1 months supply of inventory, up 0.7% month over month, rising 11.8% year over year.
Yeah, and that's the one to watch. That's the one that, to me, if everything else being equal, we know the interest rates didn't kill the prices. We know nothing else affected the market. The theory has been the amount of inventory is dictating the prices. So if the inventory starts rising and that theory is correct, prices should start coming down. So we'll see over the next, call it 6 months, if that's true, how much inventory we get on the market and how the prices react.
Okay, perfect. All right, great job, Corey, as always. Dwight, wrap us up. Mortgage side of things, again, as we said, up 27 basis points in the last 48 hours on the 30-year mortgage. What's your advice to everybody?
Yeah, here we go. We got to be patient a little bit. But I mean, if you've got a quick close, you've got to start looking at locking it and protecting what you've got now. But John, this report is really buyer friendly. So if we can just get the rates to help us out here, I mean, we're in good shape, at least with the buyer side.
And always wait, again, things get still choppy over the last couple days after the Fed meeting. So let's see if things calm down, and let's not hope, again, it's a repeat of last time we got Fed quote cuts and mortgage rates skyrocketed on that side of things. All righty, fellas. Excellent job as always. We will do it again tomorrow on the Jon Sanchez Show. God bless. Have a great afternoon.